We have witnessed some dramatic moves in the stock markets ever since 2026, thanks to the ongoing war in the Middle East and a cascade of macroeconomic surprises that caught even the most seasoned traders off guard. Right from the start of 2026, markets have been super volatile. Gold and silver moved in excess of 20% in both directions. Indian equities has shed close to about 15% in a matter of days. The rupee too has broken past key levels. Crude oil, which has been in news continuously, has also moved in line with the geopolitical headlines. For an active trader, this feels like being in a high-paced Hollywood thriller. A few old trading conventions were shaken, a few old trading philosophies got stronger, and a few new hard lessons were learned. I generally wanted to share some of these learnings with all the active traders. Hopefully, this will help them get through these tough trading situations. There are 5 things that I think needs to be addressed. Let me start with the first one. Position sizing is still the king of risk management. But the question is, how do you even position size in the backdrop of a highly volatile market? Here are few thoughts. Within a portfolio, the most volatile asset should have the smallest position. This sounds obvious, but in practice, most traders do exact opposite. They size up the asset that is moving the most because it looks exciting. The principle is straightforward. As the volatility increases, portfolio weights should be recalculated to reflect the new reality. And it is not just the volatility that matters, it is the volatility of volatility, or as traders call it, wall of wall. When the wall of wall spikes, your position size needs to shrink further because the range of trading outcomes widens dramatically. A simple but robust method is to size each position in the inverse proportion of their current ATR. ATR, as you know, is the average true range, which is a representation of volatility. The math is simple. Position size equals to portfolio value into risk percentage per trade divided by ATR. For example, if your portfolio is 10 lakhs and your risk per trade is, let's say, 1% or about 10,000, and let's say the stock that you're trading has an ATR of 500, then the maximum position is 20 shares. When your ATR doubles to, let's say, 1,000, your position size automatically halves to about 10. The advantage here is that it keeps your rupee risk constant while adjusting exposure to match the market conditions. Alternatively, if you do not want to do the ATR math each and every time, then you can use a rough rule of thumb method to position size and figure how much to allocate for each trade. The table you see on the screen gives you a practical framework of how portfolio allocations should shift across volatility regimes. If you look at the table and notice how the cash allocation jumps from 10% during normal times to nearly 75% in extreme volatility environments. By the way, this is not being fearful, it is actually being professional. The dry powder lets you trade the recovery comfortably. Alright, here's the second one. Historical volatility patterns can break. In highly volatile markets, volatility patterns can break and go into completely uncharted territory. A prime example of this was during Budget 2026, clubbed with a deteriorating global risk appetite. In theory, implied volatility or IV is elevated before a known event, like in the case of budget, and it falls or expected to fall sharply right after it, regardless of the outcome of the event. This is IV crush, and it makes short straddles and strangles profitable around events. Historically, this has been a fairly reliable strategy, but not in 2026. For instance, before the budget, the Nifty option IV curve sat between 12 and 16. It was elevated but contained. But after the budget, which coincided with a deteriorating global risk appetite, the entire volatility curve shifted upwards to 14 and 18. This was a fairly new behavior where volatility patterns changed. Short option sellers who had not sized on appropriately were hit from two sides. The underlying moved and the IV also expanded instead of collapsing. What a IV curve shift looks like in practice. When the entire IV curve shifts upwards uniformly, it is not just the at-the-money options that get expensive. In fact, the entire volatility smile gets repriced. In fact, during the budget 2026, I remember this, short strangles that were sold for 280 in combined premiums were required to be bought back at 420 or more. That was a loss of 140 rupees per trade, and this was supposed to be a safe income strategy. Now, this is why position sizing and max loss discipline matters so much for short-term premium strategies. A single event like this should not take you out of the game. If it can, then your position size is too large. Alright, here's the third one. Correlations can break down. Diversification can fail when you need it the most. One of the most unsettling aspects of 2026, at least till now, was the fact that there was a breakdown of normal inter-asset correlations. Assets that historically move independently or even inversely started to move together. Gold and equities both fell on certain days. The rupee weakened even as oil fell. Silver, which usually tracks gold with a lag, started to move erratically on its own. This is a classic feature of risk-off crisis where correlations goes to 1. Why do you think this happens? In a genuine market panic, market participants sell whatever they can and not what they want. Margin calls sometimes force liquidation across holding simultaneously. Algorithmic strategies with multi-asset risk models all hit the stop losses at the same time. So the reasons can be many. But the implication is that you cannot assume that having positions in multiple assets means you're well diversified, especially during high volatile times. During these times, you need to re-examine your correlation assumptions. If two assets that you thought were uncorrelated starts to move together, treat them as a single position and reduce your aggregate position size. One practical approach: during elevated wall of vol or volatility of volatility, calculate your portfolio level rupee risk and not just the individual position risk, and ensure that the combined worst case scenario remains within a tolerable drawdown, typically about 10 to 15% of your total capital. And this alone can help you safeguard your portfolio. Alright, this is about the psychology of oversizing. Position sizing is not just a mathematical exercise, it is a psychological one. Traders who are oversized do not trade well. They exit too early, especially when they are profitable, anxious about giving back gains. Or they hold on to loss-making positions for too long, unable to accept a loss of that magnitude. They also second-guess entries. They check their screens every few minutes. Sizing down is not about limiting your financial loss, it is about keeping your decision-making rational. The optimal position size is one that allows you to execute your plan without emotional interference. I find this simple test quite useful. Before entering a trade, ask yourself, if this trade hits my stop loss, how do I feel? If the answer is devastated or I'll not recover this immediately, then the position size is too large. Size down until the answer is, okay, I will be disappointed, but I should get along. In early 2026, many traders who normally had clear process-driven strategies abandoned them because their positions were too large to hold through normal volatility. The markets ultimately recovered on several of these positions, but they had already taken the loss. So don't treat position sizing purely from a mathematical point of view. Also think about the psychological aspects of position sizing. Alright, the fifth position is also about position sizing, but sometimes the right position size is 0. This is perhaps the hardest lesson for an active trader to ever accept. There are times when the correct action is to do nothing. Not to reduce your position, but not to have a position at all in the first place. Signs that suggest stepping aside entirely. There are few market signals that you can read which will tell you to step aside completely. For example, if VIX is above 50 and volatility gets too unpredictable, or if inter-asset correlations have broken down, you know your diversification assumptions are now invalid, or you cannot clearly define the maximum loss on an existing or a planned position, or let's just say a binary event like an election or a central bank decision or a geopolitical escalation, or let's just say you're trading emotionally, checking your P&L every few minutes or second guessing your move. These are times when you'll have to remind yourself that having no position is in fact the right position. Remember, in trading, survival is the key, even if it means not taking a trade. The market will always offer another trade, but only if you have the capital to deploy. All right, let's move to the next one. And this is specific to Nifty weekly option traders. India has one of the most active weekly options market in the world. Nifty weekly expiries create unique dynamics. IV tends to spike sharply in the last 2 days before the expiry and then collapse. In normal times, this is exploitable, but in high volatility environments, this pattern too tends to break down. IV can stay elevated or spike even further on expiry days. Hence, do not mechanically sell weekly options near expiry during volatile periods. The premiums may look attractive, but the risk reward has deteriorated significantly. Let me end this video with few final thoughts. The markets in 2026 has been a masterclass in risk management, or rather the consequence of ignoring it. The traders who can come out of this intact are not necessarily the ones who are very good with calls or directions. They are the ones who can size their positions correctly and use structures that limit their downside. These are traders who are aware of correlations and have the discipline to step aside when the environment has turned hostile. End of the day, trading is mostly about risk management, and the best trade you can ever make is the one that keeps you in the game for the next one. And I hope you found this video useful. By the way, I recently had the opportunity to write a book on Introduction to Stock Markets. The book is out for pre-order on Amazon. If you know anyone who may be interested in learning about trading or investing and want to get started, then do share the pre-order link with them. The link is in the description below. Thank you, and I'll see you guys in the next one.